Hello, I'm Nathan Kubik, and thank you for joining us for the second quarter of 2020 Transform Wealth Capital Markets Outlook. I hope that everyone is doing well and staying healthy. We are continuing to work remotely, though we are hopeful that we will be returning to the office soon. Our dedicated team continues to serve you with the exact same efficiency, systems, and tools as we have in the past. In this outlook, we will be focusing on the impacts from COVID-19, the market's response, what lies ahead of us, and how we are positioning. So let's get started. In the second quarter, the S&P 500 continued its rally back of near 40% from its March low. Even with the tremendous response from the Federal Reserve, Congress, and the Treasury Department, I don't think anybody expected such a quick and dramatic turnaround. The S&P 500 is currently at the same level where we started 2020 prior to COVID-19 starting. Additionally, there are a number of companies and some sectors that are hitting new highs already. In this outlook, we will be focusing on whether or not today's valuations are justifiable based on what is yet to come from an economic, fundamental, and empirical standpoint. Jumping into it, it's important to recognize that we had been in the longest ever bull market period, and one that took place within a Goldilocks economy. Growth that wasn't too fast or too slow, along with the economic factors that were just right. As seen in this chart, this is the first recessionary period we have had since the financial crisis. And it's important to remember that this was caused by an exogenous event and not a fundamental or structural problem. This is one of the reasons that the Federal Reserve and Congress acted so quickly to bridge the gap created by the COVID-19 economic shutdown. And this shutdown occurred around the globe. Cases in Europe spiked prior to the US and in parts of Europe to a much greater degree. It does appear that Europe is avoiding a second outbreak, but to what degree is a bit vague due to their lower levels of testing. We continue to maintain our equity exposure focused on the US. This is primarily due to a greater domestic economic strength and fundamentals, but we are watching this global case dispersion carefully. This year, from peak to trough, the US fell 33.7%, and the Europe region fell about 0.5% more. On the rebound, as of quarter end, there was a tremendous rally with the US rising about 40% and Europe rising about 37%. This rally has pushed market values to the same level they were when we began the 2020 calendar year. This is quite incredible, considering that analysts expect second quarter profits for the US to be down about 44%. In this slide, we look at market valuation multiples and see that based on historical levels, we are quite overvalued. And this is where the bubble discussion is coming from. This chart considers forward price to earnings levels, and it takes the market value and divides it by the forecasted next 12 months earnings level. With earnings expectation being so low, the question we need to ask are, have the markets run up too fast and are valuations too high? To answer this question, we need to consider what is likely to happen next. This is probably the most important slide in the deck to understand why the markets are valued where they are. Ultimately, the markets are simply ignoring the next 6 to 9 months and believe that life will be 100% back to normal by early 2021. This chart on the left paints the picture. This chart shows us that earnings levels and future estimates by year put forth by the consensus of analysts. Looking at the first blue column, we see that earnings in 2020 are indeed expected to fall dramatically. However, looking at the second column, we see earning levels for 2021 are expected to jump past that of 2019. If these estimates are accurate, then we can justify current market valuation levels. Should earnings hit these levels, it will bring valuation metrics back into a historically normative range. From our standpoint, we do believe that this outcome is an eventuality, but we are uncertain of whether or not this can occur as quickly as projected here. There are still many unknowns and much we have yet to overcome for these expectations to become a reality. Shelter-in-place restrictions have been lifted, and a second wave of the outbreak is occurring in the United States. It is important to remember that to an extent, this was expected. The intention of the economic shutdown was to flatten the curve and not to overwhelm our healthcare system. Additionally, it allowed time for greater understanding of the virus, as well as the opportunity for treatments, planning, and equipment to be put in place. Healthcare providers are in much better position today than they were several months ago, but how the second wave will unfold is still an unknown. Parts of California are reclosing and postponing school start dates. Our expectation is that this will not trend forward in other states, but this too is an unknown. While most of the world is still dealing with a rise in COVID-19 cases, Europe appears to have stemmed the spread of the virus much more effectively than that of the US. That said, just recently, the World Health Organization has warned of a rise in European cases, but whether or not this is a trend is yet to be seen. It does appear as though the fatality rates are slowing for the developed world, and that the treatments we have in place are more effective. Additionally, there is more clarity on who is most at risk for the virus. But we need to recognize that we don't know exactly what will happen next with the spread of the virus. And while there is reason to be hopeful for a vaccine, exactly when one will be available also remains unknown. What will happen economically also remains an unknown. This is truly a tale of two battles, the battle of the markets and the battle of the economy. These two battles do not move in step together, which is what we are witnessing now. However, it is important to recognize that they will need to align at some point. The equity markets are driven by earnings levels, which are driven by revenue levels, which are driven by consumer spending levels. In order to justify the equity market valuations we are seeing today, we need consumer spending levels to resume to where they were in 2019. And we need to have that happen in the not so distant future. For spending to resume and to be maintained, we also need the economy to resume its course as well. One key factor of economic health is that of unemployment. The government has bridged the gap with added short-term benefits, but we do need to get the workforce back to work. How fast this will occur is also an unknown. Additionally, we have an upcoming election. From a political standpoint, there's currently a wide divide, and independent of where each of us stands on the election, there are meaningful implications from this election. Generally, the markets do not tend to be impacted too dramatically by these elections, but this is a unique election, compounded by the impacts from COVID. This is another unknown going forward. Taking all these unknowns into account, while we are hopeful for the V-shaped recovery that is priced into the markets, we do feel that there are still risks that could delay the full recovery. And to that end, we have positioned each of our investment models with some defensive structures and risk-reducing strategies as we work our way out of the COVID-caused recession. Now, we've been talking about the market's higher valuation levels, but it's important to recognize that not every stock is trading at a high valuation multiple. This is actually a time of great disparity within the markets, which does create some opportunities. Consider here large growth companies versus large value companies. Large growth companies, as depicted in red, are trading at all-time highs. At this moment, they are up 11% for the year to date, while large value companies are currently down about 15% for the year to date. That is a 26% disparity, which is even greater than the 23% difference seen here at quarter end. While many value companies, like energy and travel companies, are struggling, and for good reason, there are also a number of value companies that we believe have intrinsically greater values than are being represented by the markets. To this end, we have instituted a bit of a barbell approach, where we are investing in great growth stocks with lots of free cash flow alongside some value-oriented stocks that we believe have characteristics and intrinsic values poised for a rebound. Additionally, many of the value companies we are currently holding have solid growth characteristics, which we believe are not properly being rewarded by the markets. We also continue to be focused on the large cap side, and that has continued to serve us well. From a sector perspective, we see that same story. Technology remains our largest overweight, and it has fared significantly better than the rest of the market. Communications, another growth sector, was next, followed by healthcare, our second largest overweight. On the other end of the spectrum, energy, financials, and industrials fared poorly. We are underweight in energy and industrials, and did reduce financials to a market weight from an overweight after its big rebound. As you can see, there is a meaningful dispersion in the sectors as well, and it gets even more dramatic as you start looking at the subsector levels. Here, we consider the first quarter and second quarter performance by sector. The star represents the year-to-date return. As you can see, not only is there disparity in the year-to-date performance, but there is also disparity in the sectors from an upside and downside capture standpoint. Technology stands out the most as it had the smallest downturn and the largest bounce off the bottom. This makes sense when you consider the financial impact to technology companies versus other sectors. Remember that much of this disparity is based on the different levels of expected earnings for each sector. And with a lack of corporate guidance, this will certainly be an interesting earnings season as estimates turn into known numbers. Here we look at our core equity model. As you can see, we have overweights to technology, healthcare, and consumer discretionaries. Our underweights are in industrials, energy, staples, and real estate. If you take a look at the forward price to earnings line, you will see that every single sector is overvalued. The rationale here is the same as what we discussed earlier, that the markets are basically ignoring the next 6 to 9 months and pricing to 2021 estimates. To that end, in addition to our equity exposures shown here, and due to the unknowns we have been discussing, we have added some risk mitigating strategies within our equity models. In this core model, we have added to our buffer cap strategy and continue to hold some gold. A similar story can be seen in our dividend equity model. Technology is our largest overweight in this model as well, with additional overweights in healthcare, discretionaries, and materials. This strategy already has an inherent tilt towards value, and this attribute did drag on the portfolio. That said, in the second quarter, individual companies with stronger fundamentals have rebounded to a greater degree than the rest of the style bucket, for which this model has benefited. We have also added a defensive portion within this model to the buffer cap strategy as well. As we enter a time period of incredibly low yields, the dividends associated with these companies, along with their strong fundamentals, should continue to look attractive and entice buyers as we move through this health crisis. Before moving into our fixed income discussion, I did want to mention that we did put out an intra-quarter capital markets outlook. In that video, we walked through all of this year's tactical moves, which we made within our investment strategies. This chart and others are described in detail within that video. For anyone who hasn't had a chance to watch that, I'd encourage you to take 10 minutes to view it. Since the release of that video, we did reposition a bit and did add some additional exposure to our hedge positions, both in early June and early July. Now, on to fixed income. Since last quarter end, the yield curve hasn't moved too much. The intermediate range of bond yields have fallen slightly, and the 30-year is slightly higher. As you can see, much of the international sovereign debt market has turned negative over this past quarter, but Federal Chairman Powell has stated that he does not see the need or the benefit to do so domestically. That said, the Federal Reserve has dumped a ton of liquidity into the markets, and Congress has greatly expanded the U.S. balance sheet. And that has been occurring globally in developed nations. As we discussed in last quarter's and the intra-quarter's outlooks, there was a tremendous disconnect in the bond markets, and this was seen for almost every type of bonds other than treasuries. This was caused by excessive supply and very little demand. To that end, the government began purchasing the excess supply to bring the bond markets back into equilibrium. In the chart on the right, we can see just how much buying occurred and how much is expected going forward. On the left, we see that this has been occurring in other countries as well. This buying has normalized much of the investment-grade bond market, which can be seen in this chart. Back in March, we sent out an email that detailed the disconnect between supply and demand and spoke to the unique opportunity in the bond market where high-quality bonds were too cheap and their yields too high. In this chart, we see the window in time where corporate and municipal bond yields spread too wide over that of the Treasury yield. As panic subsided and volumes normalized a bit, prices and yields did move closer to normal. And over the past quarter, the bond purchasing by the Fed has brought those differences in yields back to normative levels. The net result is that most investment-grade bonds are now trading where they should be. Throughout 2020, we have made a number of tactical moves in our fixed income strategies as well. We went through this chart in detail in our intra-quarter update video. This is another slide from that video that depicts our larger tactical moves this year in our fixed income models. Again, if you haven't seen the video, I would highly encourage you to spend the 10 minutes to understand how we took advantage of this market disconnect and why we believe that there are still some opportunities in this space and how we are positioned for them. We hope this presentation has been helpful in understanding some of the moving pieces in the economy and the markets. We also hope that we've been effective in showing you some of the opportunities we've been seeing and how we've been positioning to take advantage of these market dislocations. In conclusion, while we are hopeful for a V-shaped recovery, there are many unknowns still out there, and we are positioned with that in mind. Each day brings us a little more clarity and one step closer to getting through this difficult time. We remain focused on potential risk exposures and are prepared to reposition again should clarity of information shift risk exposures further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted return. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented. Take care, please stay safe, and we look forward to speaking with you soon.